pure Graham analysis. Based on the scientific evidence kept in the legendary book The Intelligent Investor by Benjamin Graham, we calculate for you the following key figures. These will be indicated for the first 100 best companies of an analyzed index. Price-to-book ratio. The price-to-book ratio, or the PB ratio, is an asset-related indicator for assessing the stock market valuation of a company. In this case, the price of an individual stock is placed in relativity to its proportionate book value. The traditional theorem of value investing implies that a stock is even less expensive the lower the company's PB ratio is, and that the company's fair value is roughly equivalent to its book value. The book value per share is placed in relativity to the stock's price. If the PB ratio quote is below 1, then the stock price is lower than the intrinsic value of the company, while a PB ratio larger than 1 actually indicates a potential overvaluation. Therefore, the PB ratio should not quote above 1.5, according to Graham back in his publication, The Intelligent Investor. Stable dividend yields. The company should have stable dividends paid within the last 10 years. We actually display the dividend yields up to 10 years of the past for our customers if that data is actually available. Net current asset value per share. Another well-known conservative analysis of Graham is the so-called net-net rule. Here, the investor is interested in the net current asset value of a given company, that is, current assets less its liabilities. Thus, the net current asset value is actually a rule of thumb how much a company would be worth to its shareholders if it would be liquidated. If this value was higher than the stock's market price, it's actually used to catch Graham's attention. However, it is not a clear evidence for an undervaluation of a given stock. We point out that the NCAFPS by dividing the net asset value by the current shares outstanding. It now becomes interesting when the current stock price is actually quoted below the net current asset value per share. According to Graham, investors will benefit greatly if they invest in companies where the stock price actually no more than 67% of their net current asset value per share. A study done by the State University of New York actually proved that theorem's effectiveness, and the strategy showed that from the period from 1970 to 1983, a given investor could have earned an average return of 29.4% per annum by purchasing stocks that fulfilled Graham's requirement and holding those stocks for a year. Companies that show these characteristics are often called net-nets. We show that on the one hand, if the current stock price is below the net current asset value per share, on the other hand, if it quotes below 67% of the net current asset value per share. There are not that many stocks trading below its NCAFPS. However, it is worth observing as an exaggerated stock market may lead to the mentioned condition, but also when companies are in a crisis and then just before a turnaround. In 1929, after the stock market crash, Graham actually found many companies of this kind. Nowadays, it is much more difficult. However, new situations of this kind arrive all the time. Moderate price-earnings ratio. The PE ratio should not exceed more than 15 on average for the last 3 years. However, if the PE ratio is below 15, the price-to-book ratio could be higher. Finally, the product of PE ratio and PB ratio should not exceed 22.5. The number results from 15 times the company's profit multiplied by 1.5 times its book value. These approaches concern mainly the very defensive investor. Criteria can usually be met only by large and very powerful blue chip companies.